I'm sharing 5 of the best investing strategies, how to get started and what to look for. All of these strategies are going to help you beat the market, and one is going to be a stress-free strategy to beat your goals. We're talking investing strategies in stocks today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. You know I love investing. I've been doing it since getting out of the Marine Corps and I've done it professionally for more than a decade as an investment analyst. So I've seen my fair share of investing ideas, from technical trading strategies from the quants to fundamental strategies followed by investors like Warren Buffett and Peter Lynch. In this video, I'm going to detail the 5 most popular investing strategies, how to get started, and what to look for in stocks. I'll highlight the risks and returns in each strategy and give you everything you need to be successful. And one of those strategies is my absolute favorite, the goals-based investing strategy. It's this strategy that's going to make investing stress-free for you and will help you not just beat the market, but beat your personal goals. You see, most of these other strategies we'll talk about are a part of that returns-based investing strategy that has you picking stocks and just chasing returns. What happens is that in these strategies, your focus gets taken off that more important idea of your own personal goals. So I'll detail those other investing strategies because they can help you make money, but be sure to stick around for that goals-based investing strategy. Then in a special free webinar I'm offering to subscribers of the channel, I'm going to go into even more detail on that goals-based strategy to give you everything you need to beat your goals. The webinar is completely free. I'll leave a link in the video description below to sign up. In it, I'm going to guide you through every step of my goals-based investing course, a 12-lesson course on customizing your investing strategy to meet your needs. Again, that webinar is completely free and it's going to give you everything you need to get started. I don't believe in holding anything back to sell people into my course. It's just there for those that want a hands-on and a detailed approach. I've added a coupon code in the video description below, so check that out also. Our first investing strategy is a favorite of Warren Buffett, value investing. Now with value investing, you're going to be looking at the fundamentals of a business, like its profitability and competitive advantages. You'll use measures like the price to earnings ratio to compare a stock with others and then to pick investors that are relatively cheaper than their peers. Now the idea here is pretty intuitive. You're buying stocks of companies that are cheaper and then just waiting for the rest of the market to catch up with your outlook. You find stocks by comparing financials and other measures, so you might look at those things like price to earnings ratio or the operating margin, which is the basic profitability of a company, as well as sales growth and earnings growth. You can also look at the price versus other measures like price to sales or just price to cash flow. Now there are 2 things you want to remember when using that value investing strategy. First is that this is all relative to similar companies, and there's actually 2 points in that. So you have to compare companies with others in the same industry. For example, that price to earnings ratio of a bank is almost always going to be lower than that of a tech stock, so you can't really compare the 2 against each other. Investors are just willing to pay more for that tech stock growth than for banks. So you have to compare banks with banks and tech stocks with tech stocks. Also though is that this is all relative valuation. Now that means that value versus some other value, not necessarily that something is a good investment. That might sound a little confusing, so let's look at an example here. If shares of Facebook are trading for 30 times earnings, so a price to earnings ratio of 30, while shares of Twitter are going for maybe 20 times earnings, that means shares of Twitter are relatively less expensive. If we also see that the stock market is priced at 25 times earnings, then we could say that Twitter is relatively less expensive as well. What it doesn't tell us is that if Twitter is a good investment or not. Maybe all 3 of these investments, Facebook, Twitter, and the market, are overpriced. Maybe all 3 are underpriced. Value investing just tells you if something is cheaper or more expensive than other stocks or the general market. Another point here is that price isn't everything. Value investors tend to get caught up in that price to earnings measure and overlook all the other ways to pick a good investment, like profitability, sales growth, and everything else. Use price to find that relative value, but don't forget about some of these other measures. Our next investing strategy is called growth investing, and this one is more in the style of Peter Lynch, the Fidelity Investments manager that nearly doubled the market return for more than 2 decades to 1990. Now, growth investing is focused on finding companies that are growing sales and earnings at a much faster rate compared to others in their industry. Since stocks are in ownership of those future earnings, growth investors reason that those earnings are what really matters, and they go after the companies growing the fastest. Of course, investors are going to be paying more for a stock where earnings are growing twice as fast as others, so that price to earnings ratio we talked about earlier is usually much higher than what you'd pay for another stock in the same industry. Now, growth investing isn't just about that sales or earnings growth. You have to look at why the company is growing as well. What competitive advantages does it have, and is it likely to carry these over into the future? That leads to some important points for growth investors. First is that you have to be careful about paying too much. Just like value investors getting caught up focusing only on those cheapest stocks, growth investors can get caught focusing only on those stocks that are growing earnings the fastest. They jump into a stock trading at a price 100 times the annual earnings. Now, that kind of price to earnings is extremely hard to justify, so the growth investor just turns a blind eye and focuses only on that growth. Now, there has got to be a balance between growth and price, and actually we'll see that in this next strategy we'll talk about. As a growth investor, you've also got to have a thesis, a reason for why that company is growing and why it's going to keep growing. Now, let me explain it because it's more important than a lot of investors realize. A growth stock is going to be more expensive on that price to earnings measure than other stocks because investors believe that faster sales or earnings growth is just going to continue into the future. The market has an expectation for how fast the company is going to grow for 2 or 3 or even 4 years into the future. If the company continues to grow, but maybe at a slower rate than expected, investors are going to be disappointed and they're going to reevaluate that company as a growth stock. Now, for these types of stocks, that investor sentiment is hugely important. Just a little crack in the enthusiasm for a company, and that high price to earnings is going to come crashing down. Your job as a growth investor is to make your own call, your own analysis that points to faster growth than expected or for longer than expected. Also, with this growth investing strategy, and this is true of that value investing strategy as well, they're less buy and hold strategies than they are strategies that are going to require constant analysis. You might hold these stocks for a couple of years, but you're constantly having to go back, analyze the growth potential or that value in the stocks, and then sell when that thesis breaks. Now, this need for that constant analysis and stock picking is something we won't see in that goals-based investing strategy. That's going to result in a lot less stress and higher returns for your portfolio. Because of the risks in growth investing that focus exclusively on growth, a lot of investors use what's called the GARP strategy, or growth at a reasonable price. Here, the focus is still on investing in companies that are growing earnings faster than peers, but we're also looking at value as well. For example, an investor looking at media companies may decide that Netflix is just too expensive, even on annual earnings growth of 232%. Instead, they might go with shares of Disney that are still growing earnings at a very respectable 24% rate, but still just priced 16 times earnings per share. Now, I like the idea behind GARP investing, getting both growth and value. The problem here is that there's really no definition or guidance in either. Investors trying to have their cake and eat it too end up settling for something that's not quite growth, but not quite value either. Just understand, when you use either of these 3 investing strategies, you need a clear understanding of the measures you're going to use and what you're going to prioritize. Our 4th investing strategy here, before we get to that goals-based strategy, is dividend investing, and this one is hugely popular. Now, when I say dividend investing, I'm not just talking about dividend stocks, but any stocks that pay a high yield, so including master limited partnerships or MLPs, real estate investment trusts, REITs, and then business development corporations or BDCs. Now, investors love dividends, and why not? Who doesn't love getting money added to their account every few months or even every month for some of these monthly payers? Dividends represent a source of guaranteed return. While stock prices might jump around from bull market to crash, destroying years of returns, that money you collect from dividends is always a positive return. We see here a chart of the total return by decade, the proportion from dividends and from price returns. Dividends have accounted for between 16% to as much as 73% of the total return from investing in stocks. Just like those other strategies though, there are some points you have to watch for in dividend investing. First is to understand the trade-off between paying dividends and growth. Now, a company can do one of 2 things with its earnings: pay them out as dividends or reinvest for future growth. Getting that dividend is nice, but not if it means the stock price goes nowhere because there's no growth in the company. Here you have to look at that payout ratio, which is just the annual dividend versus earnings. How much of its earnings is the company paying out and how much is it saving back? Is it enough for future growth, and what is it compared to peers in this industry? So you want to balance that high dividend yield with the potential for the company to grow and that stock price to go higher. Again, you have to look at this compared to peers in its industry. For example, companies in utilities and telecom sectors are going to have a higher payout ratio just because that cash flow is more stable and reinvestment might be limited. On the other hand, companies in tech and other sectors are going to have lower dividend payments, so remember to compare those apples to apples here when trying to decide if one company's payout ratio is too high to leave room for that growth. Something else to watch for in that dividend investing strategy is that it's not necessarily just about dividends when you're talking about cash return. Share buybacks, where the company uses its cash to take shares off the market, is also a huge form of shareholder cash return and has become a big part of the market recently. In fact, share buybacks have contributed an additional 3% cash return to stocks in the S&P 500. That's more than the 2% dividend yield provided. So don't neglect companies with maybe a little lower dividend yield, but that might be providing that high cash return to investors through a buyback program. Now we're on to that goals-based investing strategy, and this one is going to be different from all the rest. Here, instead of picking stocks as our focus, we're shifting that focus to our goals and what we want out of investing. Goals-based investing begins naturally with your goals. I see so many investors just wander aimlessly picking stocks and reaching for any return they can get, and they have no idea why they're investing. They may have some vague notion of reaching $1 million portfolio or investing for retirement, but they don't have a clear picture of their goals. The problem here is that when saving gets tough or when the market returns start to suck, the investor loses all their motivation. They end up panic selling out of stocks, they lose thousands to fees, and they take money out of their account. It happens to so many investors. Why would you keep sacrificing to invest if your account is going nowhere and you have no clear goal to motivate you? Once you've defined your goals, really built a mental picture around what retirement looks like or that investing goal you have, then you can start to look at yourself as an investor, how much stress you feel from stock prices, and how much risk you can take in your portfolio. It's this personalized approach that makes goals-based investing so powerful. You're not just chasing stocks, you're building a portfolio specifically around your needs. Now, since your goals and your investor type aren't going to change that frequently, the investments in your portfolio aren't going to change either. You can invest in a group of funds to meet your goals and not have to worry about picking the best stocks every month or even every year. It's a much more stress-free style of investing. It's going to save you thousands in fees and will actually give your investing strategy direction. But there's a lot that goes into that goals-based investing strategy, so don't forget to click through and sign up for that free webinar where I'll detail it entirely. I'll show you how to get started and how to manage your investments. In fact, in about half an hour, I can show you how to be a successful investor and how to manage your portfolio in just a few hours a year. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel, scroll down, and ask it in the comments, and we'll make sure you get an answer in a future video.